afternoon, everyone. Thank you for joining me. My name is Mitch Young, and I'm hosting today's webinar, which is going to be focused predominantly around business owners, the state of play in regards to tax and what common mistakes we see business owners making, and maybe some opportunities that you may want to consider to help you in a more tax efficient environment. So my company is called the Fusion Consulting Group. We were specifically created by myself and my business partner to address an issue with entrepreneurs and business owners in the UK that we felt required them to have a joined up approach to their advice. So rather than having one accountant, one tax advisor, and then explain it to a financial advisor down the road, we've essentially created our own group where we've got all the advisors in-house working around the table for the clients collectively to ensure that they achieve optimum efficiencies. So we have about 130 members of staff spread across 4 core offices, and we believe that's the way modern professional advice is needed for entrepreneurial clients and business owners. So if that sounds interesting to you, then by all means do reach out. For those who don't know me, my name is Mitch Young, co-founded the Fusion Consulting Group. I am a qualified tax practitioner and also have a social media following, so known as Mitch the Taxman, across various forms of media. So if you enjoy that sort of thing, you can find me on there and follow for some latest tax guidance and tax tips. But day to day, I am practicing working with business owners, entrepreneurs, next generation of family business owners to support them to become tax efficient. So quite a lot to pack into today's webinar. The concept is around, business owners, how they're thinking, what they're doing, structures, modern day opportunities, touch upon exit planning, touch upon inheritance tax. And whilst obviously that's a sort of private client matter, it does come into the way business owners are thinking currently as well. So we'll touch upon that, and then as I mentioned, we'll finish potentially with a question and answer session towards the end. So if you do have questions, do pop them in the Q&A or chat bar, and I'll address them towards the end. So what is the real problem? And I think it's most business owners working incredibly hard in their business at the moment, trying to remain profitable. But very few business owners have ever shown strategically how to retain the wealth and the profits within their business, how to minimize the long-term tax leakage, which is currently in place in the UK, and how to structure themselves to think about tax. Typically, business owners will rely on their accountant to produce a set of accounts and give them that, year-to-year type of tax guidance. But the most sophisticated business owners that we work with and talk about is essentially conversations about how do they retain their profits, how do they utilize their profits in the right way, and how to retain their wealth over a longer period of time. And in reality, the number one issue starts with the actual structure of the business, because many people are effectively paying tax multiple times in the terms of corporation tax, dividend tax, capital gains tax, and inheritance tax. And that cumulative tax year-on-year leakage becomes a very big problem, certainly in the UK. The UK environment, actually, if with proper long-term planning, it actually rewards strategic planning. You can mitigate tax and pay efficient amounts of tax if you have the right term structure. Particularly inheritance tax can be mitigated, and the use of your capital and profits can be utilized in a way that could be very tax efficient for you with the right planning in place. So why is there more tax going on in the UK, and where is this tax pressure coming from? So the main reason is essentially from frozen tax thresholds. We know that the government has frozen tax thresholds for many for the next few years. They have tapered away huge amounts of allowances available to business owners and entrepreneurs. Most recently, we saw the business property relief being tapered all the way down. One of the biggest changes was in and around the reduction of and change from entrepreneurs relief to business asset disposal relief for sort of mid to long term planning. Inflation drag is obviously affecting a lot of people, and increased HMRC scrutiny, which we're seeing across the profession. And where business owners essentially get things wrong is essentially them extracting the full amount of their profits and being subject to double taxes. So they're not aware of everything that can be done to reduce their corporation tax, and then they're extracting monies to then, in the form of dividends, to then invest or reinvest personally. The most sophisticated clients are thinking differently. They engage people like ourselves to look at how best to structure their business and how they're thinking. So you can see I've drawn up this table here where you've got the typical behavior, if you like, of a smaller business owner, strategic behavior, and where sort of the wealthiest families are thinking. So typical behavior from a business owner will be looking to extract all their profits, lifestyle spending, and short-term thinking. This is habitual for a business owner, where this is the amount of profits, this is what we're taking, this is the tax we're paying, and it's very reactive. And that creates quite a strain on the business and the person themselves. Strategic behavior will be thinking around the structures, which we'll come on to on the next slide, planning long-term, separating ownership from extraction, which is an interesting concept, and retaining the capital within the business. And then the wealthiest business owners and families are focused on the compounding growth of their income and wealth within a corporate structure, looking at protection and succession planning. So coming on to talk about structures, and this is essentially a really important point when it comes to business owners. If you've got your standard structure, which is essentially a limited company, if you or your business partner own the shares without a properly drafted shareholders agreement and different classes of shares, it gives you very little room to be flexible and maneuver what you're doing. The structure of the business can give you great flexibility. So if you look at the right-hand side of this table, we talk about things like holding companies, separate SPVs, family investment companies, trust structures, etc. The idea of having these structures in place is that it gives you the most amount of flexibility in terms of your dividend extraction. It gives you the most amount of flexibility and options in terms of your wealth preservation, in terms of shareholding, and it could give you some good opportunities for efficient business segregation. So one of the key structures that we look at is essentially around a holding company. Whilst there's no such thing as a typical type of structure for a business owner, a holding company and a corporate group structure can provide you with great options. And essentially what that means is, instead of you owning the shares personally, your holding company could own the shares from you. And that means that any dividend to the holding entity would be tax-free, and then you could invest those monies into another business or another asset class, and that gives you greater options. Other reasons as to why you would look at a structure, a commonly owned structure, is, let's say one of your businesses was making a loss, and then on the other side, one of the businesses or investments were making a profit. You can offset the loss against the profits within the group. So that could be strategic planning. Another option is why you may want to consider a structure, and this comes into sort of long-term planning, is obviously when you sell the business now, and we'll come on to these types of reliefs, that you pay business asset disposal relief, capital gains tax at up to £1 million, and then the rest at the higher rate of capital gains tax. Within a structure, depending if it qualifies, you can actually sell the trading business, not pay any tax, move the proceeds into the holding company for continual investment purposes. So that mid to long-term thinking and structuring could enable you, from a longer term perspective, to actually save, 6 to 7 figures worth of tax whilst sheltering it within the company. So that, at a basic level, in terms of structure and a holding company, can give you the optimum amount of flexibility. You can still, if you wanted to, so you would own the shares of the holding company, which owns the trading company, you would still flow through the personal dividends in a way that you would want to live your lifestyle through. So nothing material changes there, but it gives you the flexibility on a year-by-year basis to look at things. And this is about, obviously, the creation of the long-term wealth through retained profits. These retained profits, you don't need to extract personally, and you can utilize, as I said, through your corporate structure to make that money grow without being subject to tax at 40 to 50% of an effective rate by taking it out personally. We've had clients we've inherited over years who have just taken out large dividend payments, paid the 40% on that, and then used it to fund a property purchase for investment purposes. And they could have saved significant amounts of money if they were just focused on getting the right structure for their business in place. Just looking at, okay, we've covered this. I was going to talk about on this slide the family investment company, but it's a whole broader subject, but I'll just briefly mention it, which we'll come on to in the inheritance tax slide. But when I talk about a holding company, we're essentially talking about the holding company, which owns the shares of the trading companies, everything else. The shareholding of that holding company, if you wanted to, it essentially could be your family members. And when we talk, or when you may have heard the concept of a family investment company, all that family investment company essentially means is that it's, a fancy term for a family members owning the holding company, which owns everything else broadly. With that, you can look at attributing different classes of shares to the family members. You may want to do that for voting rights purposes, for dividend purposes. So it means each family member could take out a dividend. You don't have to all do the dividend at the same time. So one of the areas that gets looked at is around the effective profit extraction strategy for business owners. Now, over the course of time, we've seen, we've been through a lot in terms of the last couple of decades. It went from actually being able to take out a dividend, up to the basic rate tax-free for many years. And now over the past decade, it's become very, very similar from an effective tax rate, whether you're going to take out salary or take out dividends. There's not too much in it. The savings will be in and around, a bit of the national insurance, but it will come down to what is right for you and the business from a cash flow perspective as well. A lot of clients are taking more salary, less dividend, or a good hybrid mix depending on the business. Pension contributions, whilst pensions are coming into inheritance tax, for the short-term position, it still makes sense for a company to contribute towards the personal pension, because that's a way of clearly reducing the corporation tax. And it's just about looking at what is the right type of pension for you within the corporate framework. So there are things like SASs. Most people would put into a pension via the SIP or a traditional pension fund, investing in stocks and shares in line with your investment strategy. But for business owners who are putting monies into their pensions, they could explore the concept of a SAS, and that could give them, again, the flexibility to invest in maybe commercial real estate, which might be interesting to them. A SAS could give the business liquidity options as well. So with a SAS, and you'd need to speak to an independent financial advisor if this was something you were interested in, we will essentially look at, or you'll have the options around loaning some of the SAS back to your business for capital growth or investment in the business. So again, that could be quite strategic in terms of the tax efficient flow of your short and mid-term operations. Some clients, predominantly if they have historically invested in property, have seen their pension as their property, would maybe not look at, say, a traditional type of pension. But actually, when you look at the mechanics of something like a SAS, that could be very, very attractive from that perspective. Other things about effective strategic planning would be looking at, continued use of electric vehicles, still, slightly more tax efficient to operate through that. Obviously, clearly identifying all the benefits which are available to a business owner, one of which is very, very attractive, in my opinion. The company can pay for a relevant life policy for the business owner. That's a fully deductible corporation tax expense, even though it's on behalf of the directors. And that policy would pay out on death up to the value of what the your IHT estate is worth. So, when we're looking or come on to the longer term exposure for business owners on their share value for inheritance tax, actually having a relevant life policy which the company pays for, and that will pay out on death to cover the IHT bill, just makes complete sense in the short term. And a lot of business owners don't realize, along with the SAS, this benefit is available and it's not treated as a P11D taxable benefit in kind. So you know, all this strategic thinking is necessary, very necessary for business owners. And, you know, it's not just about the short-term planning. It's about working on strategy over the next 5 years. How are you going to be efficient over the next 5 years? So we've touched upon a few, you know, modern, you know, 2026 corporation tax opportunities available to you. Other things would include capital allowances, still opportunistic. If you're in a business that obviously will have expenditure which qualifies for capital allowances, you know, it's still very useful. Certainly, if you are in a business around commercial real estate, commercial property, you know, it's almost a given to obviously look at your capital allowances. One of the areas, as you may have come across, which was you know, highly attractive for the right business, was research and development tax relief, the tax credits. That's been highly scrutinized over the last few years, and now still possible, but you would need advance assurance in place first. But certainly, if you are creating something new and innovative, it's not off the shelf in terms of your products, then research and development is an absolutely amazing sort of corporation tax relief to consider there. So I touched upon this earlier, and it's very important because this often gets missed. A lot of business owners we speak to will run on a journey. Their journey is gearing up towards an eventual exit of the business, or indeed a transfer to the next generation, or transfer indeed to the employees. And obviously, when you get to that stage, you want to ensure that you have an efficient plan in place. And it's important throughout the journey that you have that in mind, so that you're aware of the core tax reliefs available on an exit. There still is attractive, you know, tax rates on an exit. Business asset disposal relief, we mentioned business property relief. Those are the two which go hand in hand in terms of transfer or sale of assets. And what you need to look at is if you are continuing to build up monies in your business, then, you know, you don't want HMRC looking at your business and saying you're sitting on all this cash, so your business is no longer trading, it's an investment business. So if you've had a business for a while, it's been profitable, trading nicely, and you've just been accumulating the cash because you haven't got the right structure or the right advice in order to know what to do with that cash, because you don't want to take it out personally to pay the dividends, then actually you could be in danger of tipping your business from trading to investment. And then what would happen then if you were to then sell the business or transfer shares, then you wouldn't be able to qualify for those business reliefs, and that would mean you'd be subject to tax at the, you know, at a higher rate of the capital gains tax or indeed inheritance tax position when you sell the business. So clean exit planning and thinking should always be looked at and reviewed on an annual basis, so that you can ensure that your business is continually able to trade. Not able to trade, but be deemed as a trading business. The other concept with this as well is that, you know, when you're creating your groups, as I mentioned, with the holding entities and the different entities all around, you want to be careful about not tipping your group into more of an investment than trading as well. So it may be at times we have clients where we actually advise to have two separate groups. You have your trading core group and an investment group. And then we come on to one of the biggest problems now, which is succession planning. So what was going on previously is that if you had a trading business, on your death, the value of your shares would go into your estate. So let's just say that's 10 million. Your business shares on your death were worth 10 million pounds. Then the estate would be able to claim business property relief which was uncapped. So your trading shares are 10 million. Your estate would then claim 10 million pounds of business property relief, and therefore you're able to pass on your family, your business shares to your beneficiaries without them being subject to inheritance tax. So, most families didn't do much planning in all honesty, in terms of, succession planning in regards to inheritance tax, because they were confident that, they'd be IHT free on death. So what's happened now, as of last month, is that the business property relief is actually capped at 2.5 million. So you would your shares up to 2.5 million on death of your business would be 100% relieved from inheritance tax. The remaining, so any value above 2.5 million, would be subject to inheritance tax at a reduced rate of 20%. So obviously this is a huge change to business owners, and a lot of companies are valued at more than 2.5 million pounds, and their shares are, and it's creating an additional inheritance tax position, which business owners would need to consider. So now it's about, okay, understanding that if you were to die today, your estate is now subject to tax of X as it stands. What can be done? Well, what can be done? Of course, we look at gifting of shares, transfer of shares. We look at, okay, where can these shares go? A lot of families who have worked hard on their businesses don't necessarily want to give the shares to their children, because they're a bit mindful of the future and what those children may do or not, and life is life. So then we may look at establishing a trust, maybe putting some shares into the trust. When you have a trust, it's the only way within the UK legislation that can protect against the bloodline. So things like divorce, bankruptcy, care home fees. So we've been doing a lot of planning for our business owners around actually sheltering some of the shares into trust, what that means, etc., etc. But it needs to be looked at. The other thing that business owners are looking at, as I mentioned, is increasing their relevant life policy, looking at exploring that to, even with some strategic gifting of their shares, there's still going to be an exposure to IHT, increased exposure. So let's mop that up with a policy that then pays into trust. So that is a current situation which is live now, which I would recommend all business owners look at as part of the strategic wealth planning and structuring. Coming up to our half an hour mark, so just a couple more slides just to conclude. So what we're seeing is, under the Labour government, we're seeing a natural, a real big increase into compliance, and a lot more demands, a lot more investigations, and a lot more sort of nudge letters into, VAT repayments, capital gains payments, corporation tax checks. So it's really important, and I'm sure the majority of people on this webinar today, have sophisticated systems in place. But it is really important that you do have your digital systems in place. Of course, you're all compliant in the right way, whilst obviously getting the best tax advice. And what we'd say in terms of sort of tax advice, and I know I've sort of provided a few options around what can be done. Often, sometimes, when it comes to tax, if it's too good to be true, it probably is. So you really do need careful and considered agile planning. A lot of it is just about modeling the right options, coming out with a few different scenarios and seeing which one financially, works for you. So in terms of some takeaways, I guess, as I'm sure you've got the message, the key thing to consider is actually your structures, and then from there, how to extract in the most efficient way, how to think about your pension strategy, reviewing your excess cash in the business on a regular basis, reviewing the ability to determine whether you've got an investment or trading position, considering the full expenses available to you, such as relevant life, capital allowances, separating trading businesses from investment businesses or property businesses, reviewing your salary and dividend strategy, what we mentioned, what's the best thing for you and the business. If you have a family, looking at the family and legacy position via potentially a family company shareholders agreements, modeling out the exit of the business. So is that better within the corporate group, so you won't pay tax on the exit? Is it better to, if you're going down the employee ownership route, appreciate we haven't touched upon that today, that would be a separate webinar. You know, are you gearing up towards that, and what's the right structures to understand the pros and cons of that, and potentially an employee ownership trust? So lots and lots to take away today. We help business owners understand their options. I write and draw out the options available to them across income, corporate, capital, inheritance tax, and we create a strategic plan together. If you'd like to speak to me and arrange a meeting with me, there is a link where you can book in a call with my colleague, who will then take down all your information and then book in a meeting with me absolutely free initially. And the way I work is I have the initial session with a client, understand their position, and then we will agree a fixed fee for my work and my project work to help structure you and the business and create some really nice plans. And then you can give those plans to your existing accountant to then, you know, say this is what we're working towards, or indeed you can then discuss with us about coming in as our client and operating within a 360 environment or not. But yeah, it'd be a pleasure to speak to as many of you as possible. So please do get in touch. So now going to sort of come on to some questions that you may have. So please do ask questions if you have them. There has been a couple of questions throughout today's session, so I'll just have a look at those and try and answer the easy ones. So we've got a question here that says the tax implications of transferring property and/or investment property within a group. So yes, absolutely. So if you transfer property to a limited company, it's likely to be capital gains tax payable. We're dealing with a lot of investors who are wanting to move their properties to a limited company. And when you look at that, you've got capital gains tax, stamp duty issues generally. Where you've got a business, so you might have a collection of properties, commercial units that have been operating as a business, then potentially you'll be able to claim some capital gains tax relief by incorporating those assets, and potentially stamp duty, land tax if it's within a sort of partnership and you've held that for 3 years. So otherwise there would be tax to pay. But you'd need to look at each and every situation within its own merit. There's no automatically one situation that would be arguable can claim relief. It will be on each given situation. Certainly, if you've only got one unit that you want to transfer to a company, that's going to be subject to capital gains tax and stamp duty. Yeah, so we've got another question here, which I'm just reading. So once you have a trust in a layered company, mortgage lending will not be possible for property investors, short of having a trust which is just for inheritance tax. Do you have a solution to this balance between inheritance? Yeah. So this is a really valid point, and this is where, you know, tax, financial, and legal, you know, all need to go hand in hand with a business owner, and it's, you know, one of those situations really, because you can go and get tax advice, and then the tax advice you go and give it to your financial people, and they'll be, well, actually you can't do this or you can't do that. So that's why this 360 approach is very, very useful. So yes, it is true that a lot of lenders don't like a multi-tiered structure. So that could mean, like, if you're with, say, I don't know, the Mortgage Works, for instance, which was historically a bad one, you know, for landlords, if we were to say, right, we're going to create instead of the shareholders just owning the properties within their one company, we're going to create a holding company, and then we may have some of the shares into trust. Companies like that don't really like that or understand that. We are seeing, as every month goes past, you know, lenders becoming slightly more comfortable, but it will ultimately depend on a number of different things, like is the main owner still involved in the business? Is there any guarantees? So there's no real one case, but, you know, what I would say to you is that it's certainly not impossible. You know, we structured quite a large business, which the dad, or the matriarch of the family, the majority of his shares were put into trust, and that was with the likes of Barclays, who you know, have sort of accepted that. So, you know, it certainly can be done, but you need to work with a good team. Your basic, you know, lenders out there, certainly if it's in property and investment, you know, won't particularly like it. And then we just answer a final question before we head off here from Lynn. What is the most tax efficient to reduce the cash in the business that could be deemed an investment company due to the cash hold? Yeah, I mean, you know, this is going to be about, obviously, you know, where the cash is and the business expansion and what the directors want to do. Essentially, it will be about, you know, reinvesting the cash. You know, obviously you could look at putting some into into the pensions, as I mentioned. There'd be the carry forward from previous years. So if you haven't utilized a pension, you can go back the 3 years and top up your allowances and do that. It may be that you invest, if you have in the corporate structures, you may want to utilize the dividend payment to the holding company, and then essentially look at reinvesting some of those monies into a qualifying asset, and trading. Absolutely. But yeah, please do reach out. There's loads and loads of things we can help you with, questions like that, Lynn. So absolutely. Yes, I've just been told to look at the chat. I was looking at the Q&A. So hi there. Thank you, Alida. If I invest in business, communication, real estate, on commercial, what would happen? Yeah, so absolutely, you can invest in real estate. So if you had your trading business, which was owned by the holding entity, you moved some of the dividends to the holding entity, you set up another entity, which would be in, say, Resi, and then you utilize that cash to invest in residential properties. That's absolutely fine and can be done. The one thing that you just need to look at is the balance. Is the balance between the trading and the investment? So that could be fine, but you just got to make sure that you don't continue to do it, and then over time the actual resi units are taking over from the trading, and therefore the whole group would then be an investment group. So can be done, but you just need to monitor the growth as you go on year by year. I'm going to post in the link again. If you wanted to book in a consultation, then the link is coming up, and you can go there, and my colleague will, you can book in the time to speak to my colleague who organizes my diary, and then he'll sync all of us to get together, have a good chat. I can find out more about your business, and then we can see if and how we can help you. But don't just rely on your accountant. Your accountant does a good job in doing what they're doing, which is predominantly ensuring that you're compliant and moderately efficient with your filings. Business owners, families require a lot of strategic support when it comes to tax, short, medium, and long term, and investing in a good tax advisor on the outset to help you come up with a plan will certainly be worth the investment. So I hope to see you all again, or meet with some of you soon. I'll be hosting many more webinars throughout the year, so please check out our marketing. And of course, appreciate your feedback via here or on social media or wherever you like. And hopefully you enjoyed today's webinar. And I wish you a great Wednesday. Thank you.